what's really good about event trading is that you get instant feedback. So I always do with my analyst and post-event analyze what we did right, what we did wrong, what we could have done better. Explain the market reaction, why the market did what it did, and we have sort of built library of experiences for 7 years.
Welcome back everyone. Today I'm sitting down with Aatu Kokkila from Finland, who is a Darwinex trader, so a funded trader with the company Darwinex, managing a pretty big fund of right now $8 million. So we'll discuss more about its experience, how he was able to get that fund in place, and he's able to trade that fund now to this day, and of course experience and tips for you. So Aatu, how's it going today? Welcome to the podcast.
Yeah, thanks for having me, Etienne. I'm doing really well.
Good to have you here. So you're the first trader from Darwinex that I talked to, I think, that I interviewed. So let's discuss how you've been able to build that fund over time and kind of manage that money. But I want to hear first about how did you start trading exactly? How did that kind of first come about?
Yeah, I started trading 10 years ago from a tip. I got a tip from a friend that I should look into trading because I was really good at video games. I used to teach people to play World of Warcraft for money back then when esports wasn't a thing. So he thought that there's a lot of parallels between video games and trading. And then I started studying markets and I started with my own money, what I made from playing. And then I put a track record into the MyFX book, and I was found by my current partner. 7 years ago, we established managed accounts. And we around that time, I think 6 years back, 5 years ago, actually, we found Darwinex as well. We put a track record there as well. And we've been running managed accounts. At the point we had a usage hedge fund, and now actually we are fully consolidated at Darwinex and Capriva. So we don't have managed accounts anymore. We are an investment advisory, and that's sort of my background in short.
I mean, that's a short summary. So I'm curious to hear what's been going on between starting to trade first and then being able to get funded by Darwinex. How long are we talking about? It's multiple years, and kind of how did you have to go through to be able to learn trading? Was it easy for you to learn, or did it take a long time?
Well, I was really lucky because I kind of figured out, so we trade events and monetary policy events. And when I started in 2012, it was highly volatile market with European debt crisis. So it was kind of easy to make money from the get-go so for the trading style, even though I was, so I kind of was lucky back then. But obviously after that we have went through various different market conditions, but it wasn't that difficult for me to start. Obviously there's been really more challenging periods in between, during the career. But to answer that question, no, it wasn't that difficult.
I'm sure like most people, you had a time where you were not profitable. You were trying to learn to trade. You couldn't really trade profitably back then. What did you do that kind of help you change that and turn this around to becoming profitable in trading?
Yeah, I think the issue was that I was trading so high leverage from the get-go that I'm trading all money. So it was the drawdowns were just really, really high, even though the returns were also high, like something that you would never ever sell to anyone. So I could just, when trading with your own money, it was easy to stomach. But in 2014, I figured that if I want to receive investment, I have to really keep the drawdown in check and trade in a more structured way. And then I figured out that, I can create strategies around monetary policy events and data events in Forex markets where you actually have really sort of really good high risk reward moment. So I guess that was the point where I sort of crossed the line between being lucky started to more professional level of trading. So it took actually 3 years.
That's not bad. Yeah, it's about the average time I see for most traders to get profitable. What about trading style and strategies? Was it easy for you from the start to find your trading style? You had to try multiple things, and how do you come up with your strategy and what you trade now these days?
Yeah, like I said, I think I was lucky from the get-go because I realized that, with events. Well, I was really interested about economic news announcements in general and events. So I just saw that there is, contrary to the academic paradigm that markets follow random walk-around events, that there's definitely opportunities and it's in the end it's people interpreting those events. So I figured that there's definitely alpha to be made with those. So I figured that quite early, but it wasn't until 2014 that I started structuring trading strategies, trading plans around those events. So it's kind of at the moment, our trading plans around, let's say, an ECB, European Central Bank interest rate decision, what we do beforehand is kind of similar to equity research, that we do like a big plan, think about scenarios, and if there is something unexpected happening, then we are looking to trade that, or something as expected happening, and we sort of then we would look to mean revert that. But yeah, like I said, I found my style really fast. I guess it contributed a little bit that I read a lot of books and figured out from them that you really want to figure out a trading style that fits for you really fast.
Tell me kind of how this went. So you upload your stats to Darwinex right now. You got to keep trading, of course, build some more data there. Did you were approached from the first few months from investors? Or did that take a long time to kind of build up? And did you expect that you would get so much money from Darwinex in the beginning back then?
Yeah, actually, with Darwinex, I think we grew in 2017 already to like 5 million back then, and then our performance sort of stagnated after that for a period of time. So no, I definitely wasn't expecting. I saw that the platform is really professional, but we were kind of learning the ropes in terms of brokerages, fund management back then. How do you we had this setup where we had managed accounts, then we have Darwinex, all these running, all these accounts, several accounts running in different places, and that wasn't optimal. As in comparison to now, we have everything consolidated at Darwinex, which we execute at a single broker, and we don't have any liquidity issues that used to be there. It was kind of, we had to learn that and understand how liquidity works as well, because we come from unconventional background in the sense that we don't have any experience from trading for a big bank or something like that. And yeah, I mean, the Darwin actually sunk in assets, I think in 2018 to 2020, it was between 1.5 to 3 million. But since having consolidated last year everything at the Darwin, we've been growing at a significant rate.
That's surprising because you can grow really fast with that platform. Surprising, and this is not sponsored by Darwinex in any means. So just want to make this clear for people. You've been able to get a lot of good success with it for sure, and I think that's a good way. Tell me about the mindset. So there's a big difference between trading on your own account, like your own capital, versus trading other people's capital through Darwinex. Like, you manage a lot of money with that. If you make the wrong decisions, people will be impacted by it. How does that feel? Like, how do you manage your mindset when you trade such a big account for different investors?
I think it's imperative that, like as an fund manager, you have to be invested yourself into the fund, in the sense that I feel the pain more for losses than investors. I think the captain has to go with the ship in that sense. Although I do see, obviously, psychologically, you want to have at least for me personally, it works best that I have living expenses covered for a few years forward. But that's it. Other than that, I'm fully invested. And yeah, I think expectation management is a big thing. Like, we guide our investors that we, on average, we make a 15% a year. Obviously, that's an average. Like, with in different environments, it can be a lot more. In different environments, it can be a lot less. So I think the core thing is the expectations management and also being invested yourself on the fund.
That's tough because some people might believe that because they invest in your fund or anyone else's fund that they will get returns like every month from them, like the same thing every month. But it's actually not how it works in trading. So you got to be able to tell them to adjust correctly.
Yeah, exactly. Absolutely.
You've been named, I'm curious to hear this, you've been named one of the top 5 funds, I believe, on Darwinex, or one of the, actually I have the award here is the best performing fund over 5 years at the award of the Hedge Fund Journal CTA. So what I'm curious to hear here is what do you think differentiates you from the other funds? Is it just like a performance thing, like you make more returns than the other funds? Or is it like something else that kind of differentiates you from these other funds?
Yeah, I think it's quite big award. I think there's been really limited volatility in FX markets past 5 years. So even though I think we did a good job, I think it's been a reflection of, like, FX markets has not been the place to be. For example, between 2018 to 2020, when the stock markets were booming higher and cryptocurrencies were shooting up. So I think it's been a tough period for FX CTAs, but now obviously with interest rates rising, it's getting better. But I think we are compared to general big CTAs and currency funds in general for the award.
Did you switch market to other markets when Forex was not performing so good, or did you just stick to Forex and find ways to adapt to this market?
No, I stick to my guns with Forex. I think it would have been too big of a learning curve to try learn different markets at time. I think we could have also done better at the time in terms of performance. There's been a lot lessons from those years in a sense that there was still some volatility around events. The events were pretty much only thing that were moving markets, even though FX was stagnated. So I think if we ended up in a similar situation now, having learned from those lessons, I think we would do actually better than past those years.
Yeah, it's kind of how trading is. You go to some new places, new things, then you kind of learn from them, then you can invest just to the exam happens the same way. So you gotta have periods of where you learn that way for sure.
It's all about sort of you kind of make the same mistakes, but you want to make them in a lesser degree, in smaller degree, right?
Exactly. How do you learn from your trades? Do you have like a process where you go through your past trades every few weeks or months to kind of learn from these trades?
Yeah, what's really good about event trading is that you get instant feedback. So I always do with my analyst and post-event analysis what we did right, what we did wrong, what we could have done better. Explain the market reaction, why the market did what it did, and we have sort of built library of experiences for 7 years around those events, and then of course we freezes them back into history 20 years back. So yeah, I think. Those events provide a really nice base on what you can build in terms of improving and reflect how you can improve your trading.
As an event trader, do you trade like before the news or after the news, or how does that kind of play out? What's the kind of trading style there?
Always after the news. I think trying to predict the events is impossible. It's like somebody who claims that you can predict the events. It's equivalent to astrology. I mean, you cannot predict them. What's our edge is really understanding those events and seeing if there's a market has priced the information correctly.
So that means you're combining fundamentals and technicals, or are you only looking at technicals for these events?
We are definitely combining both, but for the immediate signal, it's about the fundamentals. So we figured out that usually the fundamental signal moves the markets for let's say, it depends on, it's really situational. It really depends on market context, but for a given time. But of course, technicals impact the markets a lot as well. Different signal has a different impact in a trending market and so on. So all these need to be incorporated. In the past, I've definitely made a mistake that I have, thought that the fundamentals matter more, and I've thought that maybe the technicals, it's not intellectually sound that the technicals are pushing the price. But once you lose enough in such instances, you really need to just understand what's moving the markets, and sometimes it's technicals and sometimes it's fundamentals.
That's a good point, because sometimes you can have a news that's going to be, let's say, a very good news, but it's a bad thing for the market. The market goes down from that news. How do you kind of determine what the market will do? Is it based on fundamentals there that kind of tell you where it's going to, or where it's likely to go? Or is it something else?
Yeah, it's based on the, always initially based on the fundamentals. Maybe I should show a trade example if that would illustrate. It's a bit difficult to...
Yeah, if you want to share your screen, it's totally perfect. You can do that.
So this is 5-minute chart from Bank of England in June, Bank of England decision. They raised interest rates by, let me type it down to maybe illustrate it a little bit clearer. So they raised rates by 25 basis points. So the key thing here is to understand that market reacts based on what is priced into the market, right? So there was a 30% chance of 50 basis point hike. So this is why the initial reaction is that the pound is sold within, but usually the interest rate decision itself is really easy to price for markets, because that's something that it's really easy to create an algorithm for trading that. But when it comes to the language, it gets more complex. So the larger driver here for the initial bearish reaction on pound, it moved like 110 pips down. So even though there's a huge reaction here, this was already 110 pips, which is a big reaction. So the big initial thing, what they signaled is that they removed further hikes in coming months. So the markets interpreted that based on that the Bank of England is not hiking more rates, and sort of there was a lot of rate hikes priced into the market. So that is very obvious initially. But what they also did, they actually just substituted that guidance with ready to act forcefully. So now what this actually meant is that forceful guidance, using the words forceful, is something that the bank is ready to deploy 50 basis point hikes in the future. It's used to signal that it's conveyed in past central bank communications. Bank of Canada used that, for example. And the market got it entirely wrong during the first 15 minutes. Actually, what happened to us is that we already were trying to mean revert the movement immediately, and we were right too fast initially. But that's why we don't always deploy our full risk immediately. It can be difficult to time the positions immediately. So this is something that, based on a lot of experience, we have learned to actually take the risks around the event. And so we got initially stopped out for small parts of our positions. We were of course looking to long it, because the big signal here is that they are actually going to, in the future, raise rates more aggressively. And the big thing to understand about interest rates in general is the future, what matters for markets, not the immediate decision. I think it can be sometimes a bit difficult to understand that how the market pricing works. So here we deployed some leverage. We got stopped out initially. And then after 15 minutes, the market started going up, and we deployed our final position then as we started. So price action is really important input for us, as well as something that we look at. The price action needs to align with our thesis. That here you had also a short squeeze on top. So that's what I mean, that the technicals matter. So we got in with really good entry prices for the rest of our positions, and I think the pound moved higher by 300 pips from the bottom, over 300 pips actually, 350 pips. It's one of the biggest moves this year on pound. So in intraday basis, this is sort of what we did here, is that we understood the signal. I think by itself, if there wasn't a technical short squeeze on top, the move would have been worth maybe 100 pips on pound based on our research. But because we were aware of that technical factor of the short squeeze, we only took partial profits after the 100 pips and wanted to see how the price action develops. And since there was no real retraces and the momentum kept going on, we held a large chunk of the position and exited it only after the day end. So I think that illustrates our trading pretty well, this example.
It's very interesting because it's something that I know most people would not trade, because you got to be very intense for like a few minutes to like look what's happening in the news, look at how the market reacts to it during the news. I think it's a very intensive style of trading. At the same time, you don't get like many opportunities every week. You might get like 3 or 4 per week. Am I mistaken?
Yeah, I mean, sometimes it can be even less. I think it's the misconception that news moves that much. It's really depends on the market gives the opportunity. If this event was priced right, the pound would have moved up 100 pips, and there would have been a trade for us, right? Sometimes there's much more events, sometimes there's less. Sometimes there might be a month where there's just 1 or 2 events. And now with a lot of focus on interest rates, there's a lot more events. Data events, for example, are moving markets much more nowadays, like the US CPI this week and non-farm payrolls last week obviously moved FX a lot. So it really depends on the market context. Whether interest rates are a big driver, then the data and the central bank decisions are moving the markets a lot.
What made you get out of this trade? Is it based because I see you got out of the trade by the big like bullish candlestick there? So is that a reason for getting out, or was it based on a fixed level? How do you decide to get out of your trades?
So we have researched these events like almost 20 years back, and I've also traded them myself for 7 years. So we compare to past signals what this kind of signal is worth in intraday basis. So usually it's few hours that we are holding a position, and in this case, like I said, it was partial profit because of the fundamental signal. We thought that it was priced in compared to history. Correctly, it would be 100 pips moves up in pound. But then again, we factored the technical aspect here, that the market was kind of unique in this instance, in a sense that there could be a chance of short squeeze on the pound. We factor in other drivers that were happening on that day in the markets. For example, the Swiss central bank raised interest rates by 50 basis points. So that was something that we thought might be interpreted ultimately dovish for the dollar.
it's a big understanding of fundamentals and kind of looking at the news. And also you mentioned like the past data. I think that's super important. Is you looked at the other setup in the past to determine how this one is likely to work out. That's a really good point.
Yeah, absolutely. You have to factor in everything that's happening in the markets, and sometimes there are bigger events than the monetary policy events that are moving markets. So you have to be really aware of the news flow in general and understand what are the big drivers for markets.
I know a lot of new traders who trade news are focusing on like they want to trade the same, like the news always the same way. So for example, they always want to go against the trend. They always want to go with the trend. They always want to trade the breakout, or they always have like this one way to trade it always. You're saying it's more about how the news is and then the context around it. And with that, you can make a decision whether you go with the trend or counter trend, or just don't trade it.
Yeah, exactly. I mean, we can trade momentum as well. Actually, our best trades are often with momentum when there's a really unexpected signal. But it really depends. It's our key edge. Our edge is in understanding the market context and the event in question, how it should be priced. And oftentimes we have a instance where there are, technical drivers where we might be holding a position when we are profitable in a big fashion. Like here, we were profitable 150 pips. That's why we were holding them. We don't like to take views in longer term out. I've been very. I'm obviously really opinionated person as well, but it's something that was tough for me in past years, and something I'm still working on is not taking, not trusting my own big narratives in terms of the market, but having faith in the research and being more objective about it. Because it's really easy to create sort of intellectual narrative where the market should be going, and then the market does what it does, right? And your narrative is just wrong, and you just have to accept it.
That's a good point. Do you research or do you read any kind of websites with the news about like what's going on, like the fundamentals there, or is it just based on like who you listening to let's say the Fed people, the people who do the announcement, or you actually look like for analysis for the people on how they interpret things?
Whenever there's a given event, there's a headline feed. We look at Reuters, so the Reuters journalists get to pick what they view as most important headlines in forehand, and those are published immediately during the event. And then not always do the journalists get it right. Actually, most of the time they miss something important. So we actually interpret and read the central bank statements, what they release on their website, and we have identified beforehand what's important there and what we want to read. So that's what my analyst does. He reads those, and then he announces the key parts from them, what the journalists have missed, and then we make a decision to trade once we have all the information we have determined beforehand we need. And if the market is aligned with our sort of scenarios that we have created before the trade, and we think that this is either a mean reverting or a momentum-based scenario, like here, this was a mean reversion scenario.
Interesting. So you're not actually the only one looking at the whole thing here. You don't have to do like all the work yourself. You have people who kind of do the work for you. Also, some analysts who look at that. How does that work out?
Yeah, I mean, I think I was doing it alone, and it was really, I understood that it was really, I was like a rally driver without no node reader. I think it's really important. You have two persons working there. There's so much information to process. So what we do is, before an event, we both have our tasks. Obviously, I select few information bits. If there is an instance where we need to react fast, I'm reading those information parts myself as well. But when there's a slower trade, like in here, where you need to really understand what the signal means, then we are taking it more chill and interpreting it together and thinking, what does this mean? What does this mean in comparison to the pricing, and how does it align with our scenarios that we created beforehand? So that's pretty much the process what we are doing during an event. And then, of course, what we keep thinking all the time is the take profits, risk management. If the market doesn't react as we expect, what do we do? Do we exit earlier? Stuff like that. How does it align with our sort of historical analysis, our implementation rules in general, and then we take the decision. So there's very little impulsive decision making, even though it's in a short period of time. It's always everything is really structured.
What's the behind the scene like of managing capital for Darwinex or like any other like platform or something? They have a lot more tasks that come in with that. Like let's say you have to do customer service with people who reach out to you, ask you questions about your fund, or do you have to do more things? Or is it just like the same, you just trade your own thing and then you're kind of good to go after?
Yeah, I think that's the really brilliant thing about Darwinex, like having managed a fund myself, like a bigger fund. It was really stressful because there was a lot going on with in terms of the investors. They wanted frequent updates and communication constantly. And with Darwinex, actually, we don't need to. The only things we are doing ourselves is that we are trading and focusing on asset raising, and I release an investor letter every half, and that's it. But with the fund, you have much more reporting requirements and so on. So it's a really brilliant innovation what they have done. You can basically run a hedge fund with minimal focus on other things than trading. And another big thing is that running a real hedge, like a usage hedge fund, the costs are really high. So we basically run with very little cost with Darwinex because they provide the regulatory umbrella. They sort of incentives are really aligned with the investor, the trader, and the sort of umbrella, because also Darwinex gets a cut of the performance fee, but I think that's really fair, so that they provide us the best execution, and of course they provide us with the platform, they take care with lots of marketing material and all that kind of stuff. So I think it's an industry changing innovation. It will be in the long term, as long as more fund managers, like smaller fund managers who don't have the resources to run a big fund, embrace it.
And what would be your advice for people who want to have a fund? They want to be able to start either with Darwinex or outside Darwinex, but they don't know exactly how to get there. They don't know how to get the right people to invest in them. They don't know how to improve their trading first. What would you tell them to kind of focus on to get to that level?
Yeah, I mean, of course, it all starts that you have something, you have a clear edge, like something you figured out, something that maybe others haven't. And once you have that side down and you have a really strong track record for few years with low drawdown and high sort of highest return, I think like investors are in general more interested about track records with lower drawdowns and still, like, you don't need to shoot the lights out in terms of the return. But from that, I think the good thing about Darwinex is that you just put your track record there, and if you have good enough risk-return relationship, after a few years, you're gonna start getting traction. People can see your results live, and you can get investment immediately as a retail trader.
This is something interesting I want to ask you also, is the fact that you might think on this Darwinex that you have to have a really high return, like a very high performance for people to be interested in your fund, because they might look at like the one who's making the most money is the one they want to invest in for sure. But with you, it's the opposite. Like you're showing you make 15% a year, and that's giving you a lot of capital from Darwinex and from people. So what's kind of like the sweet spot, in terms of like the drawdown and the return? Is there like a sweet spot, something you recommend people to aim for, or anything reasonable is fine?
Yeah, I think it's all about the return drawdown relationship. I mean, if you have 15% return with the 3% drawdown, that's amazing. I mean, it's the equivalent of 75% to 15% drawdown a year. I mean, both tracks are similar and the same and really strong. So that's what everybody is looking at. Based on my experience, institutional investors really look at lower drawdown and the return being low as well, and they like that. Obviously, for us, we've had periods of higher drawdowns. I just think that 15% a year, even with like historical drawdown of 15%, if you can keep that up, that still beats the stock market. I think that's easily enough, as long as you communicate it clearly. And you provide uncorrelated return. That's easily enough to attract investors. And you have to really get good at communicating your edge. I think that's something that we have done to our investors. We've always explained what we do, and investors have liked our investor letters and so on. So these are two things that I know a lot of traders that are really good at the trading side, but have a bit trouble communicating why why are you so good at making money. So when you have these two things combined, you have a ready package.
Do you know if people who invest in Darwinex are people who are traders, or they are people who are just investors who want to kind of diversify, or do they kind of still know trading and still want to get involved with traders?
I don't actually know myself that well the investor base at Darwinex, but I can imagine that many investors moving to Darwinex are somebody who is, who wants to diversify from your traditional equity investments because it's completely uncorrelated. I think that's the big edge for somebody creating a portfolio. You have maybe S&P 500, then you have a few Darwins there which you trust will perform. And in difficult years for stock markets like this one, the Darwins can be performing well, and on the opposite, when there's a strong stock market, you have a much better risk reward relationship in your portfolio when you combine those. So obviously everyone knows diversification is one of the only free lunches in the game. So for that reason, I think the Darwin provides a really feasible investment.
I think traders who manage who want to manage capital for investors would have a lot more success if they focus on this aspect of like diversifying the investors' return compared to like getting all the capital. Sometimes people want to get the most capital possible, but they can find multiple investors and just like a little bit of capital for them to diversify and then trade that capital. So they don't have to like take all the capital from an investor. It could just a small part of it, but that still makes sense for them, and of course makes sense for you as the trader. So it's a good idea.
Yeah, absolutely.
When can people reach out if they want to connect with you or see what you're doing? When can they find you?
You can find us on our website, Finbou HE, and you can find us on LinkedIn as well, me and my partner.
Awesome. I'll make sure I'll link these. I'll put these things through the description of the video here and the podcast show notes as well. People can just check them out directly and reach out to you if they have any question or see what you're doing there. It's been good to talk to you, Aatu. It's been good to connect. Good to see what you're doing, of course, as a trader for Darwinex, a $8 million trader, which is awesome, of course. And definitely want to catch up in the future, see how you're doing with this, see how you grow, of course, and what kind of goals you achieve. Now, I'm curious to hear what kind of comes from there. Like, now you have $8 million from Darwinex. What's the next step? What do you want to get to next? You want to keep kind of trading that capital, or where are you trying to go now with that in mind?
I think, we have capacity because liquidity is a big thing for event trading. I think we are running maybe at 40 to 50 million. So that's the next logical step. We've been at 35 million in 2018 already, but I think we are now more experienced and the market environment is significantly better for us with interest rates being interest rates and inflation being the big focus. So we trust our edge will probably work really well in these markets and looking to grow quite fast in the coming years. But of course, this time is different in a sense. When we had that 35 million, we didn't do that good job with expectations management. So what I really emphasize this time to our investors, and on average we target 15%. So we are up 30% this year, but it doesn't mean that we will make 30% every year, right? So that's really important part, so that the investors know that you want to be in here for long term, and sometimes there might be stagnation, sometimes there might be overperformance. So that's where we are going in the medium term.
Definitely, and people have to also trust you. They have to trust you can deliver the results, and you say what you do what you said before. I think that's very crucial. So that's a lot of communication there, and like how you present what you do also in the background. Oh, that's awesome. And I feel wish you the best of luck with this. I know you're gonna probably get there at some point for sure, with the skills you have, with what you've learned over the past few years. That's good. And let's catch up whenever you get to that number again. I'll be curious to see.